Okay, tonight we're going to talk about a couple of issues. One is compound interest, and two are and bonds, everything kind of related in a financial side, because I'm assuming most of you want to retire someday. And that means, how do you save for the future? Well, there's a lot of things people tell you, and there are certified financial planners, certified financial analysts, and there's people that will charge you money. So they invest your money and then they take a piece of your money. And then there's something called a fiduciary, and we'll talk about what a fiduciary is. Some pretty basic, generalized, shall we call it, financial stuff, kind of some buzzwords. And then the next thing we'll talk about is some empathy, sympathy, a little more on that. But in specific, I'm going to bring out some stories from my experiences that I saw in the workplace, okay? And those are legit stories. And I just finished listening to Michelle Obama's book called The Light We Carry. A very insightful book on the business front at the intersection of being a double minority, female and Black, in a lawyer's office. Very interesting how she had to navigate that. And to be quite honest with you, it was new knowledge to me. I had no clue what code switching is for minorities and people of color in the workplace. It's an interesting topic. I'm going to go read more on what code switching is and how it works. I understand it from the book, but at a more in-depth detail, and that fits in with this empathy stuff. Okay. All right, let's start with the money side. Now, the reason I want to talk about compound interest is even Einstein said there are two types of people: those that know the power of compound interest and those that don't. And in some of my beginning programming classes, I have them create a very simple program. It's called the Rule of 72. And this just uses a straight ratio to create an earnings graph. This is wrong at so many levels. The Rule of 72 is a rule of thumb that basically says your money at 7.2% will double in 10 years. Okay. So having your money double in 10 years and saying, well, where am I going to get 7% these days? That's why I want to talk about bonds. Okay. So the Rule of 72 is basically 7.2 interest. And the way this works is when I run this is just a very simple, and I'm going to use 7.2 just to show you how the formula works. Oops, not 70. That'd be great if it was 72%. Loan shark. And then the money I'd like to see double. I'm going to say $1,000. So it doubles, okay? And then in that time frame, that's how much money you earn by doing absolutely nothing. You're not putting in any more money. You just set it and forget it. Now, the actual interest rate, compound interest, is that formula. This formula is set up, and you do have to read the financial statements of your investment vehicles, because sometimes they calculate interest on daily or quarterly, annually, semi-annually. Daily equals 360, which is legacy, or daily equals 365. Okay, hold on. Okay. All right. I think somebody has an open mic, which is fine. But this particular formula is what's used in commercial banking, commercial lending. So when you buy a house at 7, whatever it is today, 7% interest, the amount of money you pay back to the bank is almost equal to the amount of money you borrowed. Not quite, but it's kind of a freaky curve, and it's really depressing. So really what you want is that you want the compound interest to come your way. So how do you do that? Okay. Well, here's some very simple. Here's another calculator that's a little more accurate. And this particular calculator will let you put in, I'll say 10,000, and I'm going to use an interest rate that I saw today at 4.5%. And it happened to be calculated on a monthly basis. And I'll put it in for 10 years. And then this is where you can make deposits based on money or withdrawals, or both, depending. I'm going to say none. What I'm trying to get across with compound interest is when you put your money in and you set it, forget it, 10 years, how much money do you have? Okay. So, and daily you have a choice, 365 or 360. It depends on the fine print. Okay. And this is basically what would happen. So the future investment value, in other words, in 10 years at 4.5%, I earned $21,000 by doing nothing. Okay. Don't talk about those issues in this context, because the liquidation depends on where you put your investment vehicle. Does it have overhead? I'm assuming most in this class have not had any financial literacy training in their career. Okay. So that's what we're doing. All right. We're just talking about very basic stuff. Okay. All right. So you can see that it creates quite a powerful bang for the buck when you're investing and you're looking for things. Now, when you are trying to maximize your return, there's lots of ways to do it. But today, I want to introduce something for you as a student you can do
I forgot a
on
bag.
your own without anybody's help.
We forgot a bag.
Is this advice? No, this is not advice. This is some.
Oh,
It is
bag. That's it.
one. It's an option, and the reason I'm bringing this option up is I bet you don't know about it, and I want to expose you to this vast world of finance and investments, because there's always programming jobs here. Okay. So this is the one I want to talk about. This is Treasury Direct. Anybody heard the term savings bond? I'm curious. Anyone throw a thumbs up, shout. That's what I thought. A savings bond is a way to basically, you give $1,000 to the government, they give you a bond, and then they pay you interest. And that interest is yours. And in some states, they will charge you income tax. Some states don't. California state bonds are non-taxable. So if you buy a muni bond for Sacramento, and it's part of the state, you won't have to pay taxes on it when you cash it out. Bonds are about as conservative of an investment as you can get. Now, the reason I bring this up is that everybody was yapping about, oh no, we're going to default, the default. Okay. Now, Charlie, you don't have to say everything you think. The interest thing I'm talking about on government bonds, yes, is from the 80s. But did you know that on June 6th, they issued bonds in $100 increments that are paying 6.19%? Today, through Treasury Direct, 6.19%. It opened on the 5th. Okay. Now, I have a few of these. I don't buy too much of them because I prefer more aggressive. And this particular investment is really conservative. Okay. Unless the US government goes belly up and the whole world walks away from the US dollar, then that's a different story. But the yield curve on how all this works can get complex. So what I want to do is show you a fun little website or a book. Now, this is an old book, very old, but it's one of the cleanest definitions of how the bond yield curve works. And this was written when T-bills, you could get 14% on a T-bill. So a T-bill is in increments of 10,000, and you could get a $10,000 T-bill at 14%. That just doesn't happen anymore. But there is a term in the bond world. This is the updated version written by one of the same authors. It's called callable. A callable bond means I'm going to buy $100,000 of federal bonds that are going to pay me 6.19%. And it's good for 10 years. Well, the government at year 5 says, nope, we're giving you your bonds back. Here's your interest for 5. That's what a callable bond is. In other words, the government has the option to redeem it and then pay you the interest, and then they get their money back. They do this when foreign countries buy billions of dollars in US bonds. So when China buys a couple $100 million blocks of US treasuries, they're callable. So the US Treasury can say, nope, here's your interest for that. We're going to keep it now. We don't want to pay you anymore. So that's a buzzword within this bond business. Now, I don't know how many have a stock brokerage account. Brokerage accounts usually charge you to buy and sell individual stocks. And it depends on the company, how much they charge. And there's a couple ways to get around some of it. Is I personally like Vanguard because they have very low overhead. Okay. They don't charge a lot of overhead. Bogle, the guy that started it, who he was very pro investment consumer, very pro consumer. So he set up his whole company to have this ethic of give the returns to the people, not to the stockbrokers. Does a crypto wallet count as a stock brokerage? I doubt it. Bitcoin, now everybody loves to jump up and down on crypto, and I've been proven wrong, I've been proven right, I've been proven wrong, I've been proven right. I see Bitcoin, specifically Bitcoin, as the Dutch tulip bloom craziness in the 1600s. People sold everything to buy tulip bulbs and then just went poof. Reason being, Bitcoin has a technology problem. It costs way too much money to mine the Bitcoin. There's just not enough energy. Two, they're running out of Bitcoins. That's only finite. So there's a finite number of coins. How many coins are on old beat up hard drives that have been shredded? They're unrecoverable. I personally don't do anything with crypto, but I do keep my eye on blockchain. And I have been investing in the companies that have investing in blockchain. Let me give you a case in point. Overnight currency exchanges. The United States, or let's just say let's say JP Morgan Chase, they'll take $100 million and they'll throw it into an overnight currency exchange market and then pull that $100 million out in the morning. And they will have made money on money overnight. The reconciliation process of that with blockchain is in seconds. That's a huge payback rather than in hours or days. So think about that. You put $100,000 into an overnight market and you bring it back out, and it takes a few hours or a few days to reconcile that everything's right. When you can reconcile in seconds, you're going to make even more money on money. So I have been for me personally, this is not advice to you, this is just what I do, is that I look for the companies that are investing and doing R&D on the blockchain tools. That's where the gold mine is. In the gold rush days, the people that really made the money were the people that mined the miners. They were the one that sold the axes, the jeans, the pans, the donkeys, the camping equipment. Those were the people that made the real money in the gold rush. Money's in the middle. Always has been, always will be, as long as you're in a capitalist system. Okay? So look how the money in the middle is being divvied up and take it from there. Okay? Now, you can invest in crypto all you want. I'm one way or the other. Doesn't matter to me. Ethereum, which is one of the other big blockchain, they are actually a commercial grade company now, and they are the company that's working with JP Morgan Chase and Bank of America for reconciliation. That's why it was such a big deal when Ethereum changed from proof of work to proof of stake, and they'd flipped the switch and it worked. That's dramatic. What that does is it creates a ledger that can be traced. And it also means the energy requirements drop by 60%, give or take 10%. I don't remember what the number was, but it was huge in cost savings in the mining of Ethereum. Okay. Now let's talk about more about this bond stuff. Okay. Now, the reason I'm mentioning this Treasury Direct is you don't have to go through anybody to do it. You open an account and you can buy $100 bond, and they do not issue paper bonds anymore. They will issue you a serial number. You better print that out and put it in a safe deposit box, because you do not want it to go by way of a Bitcoin on an old hard drive that you forgot about. Okay. Now, this is not a one-time thing. You can recover it if you've set up your thing. The kids' grandparents bought these savings bonds, and then when they went to college, they cashed them all out, and I think they got a semester of free tuition from saving bonds. Okay, so you can manage them, sell them, look for ones that are mature. So these is, see, that's not real high right now. That's not very good. And then Series I savings. Now, what's I mean? Does anybody know what I means for Series I savings bond? It means interest protected. What this means is if I put in $10,000 and all of a sudden interest rate spikes, I'll get my $10,000 back plus interest. Okay. So here's these bonds and the 10-year notes. This is what they call T-bills. Okay. And then they have, this is how it works if you want to buy them. Treasury. So there's a limit to how much you can do in the eyes. Okay. This is actually, if you want an inflation protected bond, this is actually kind of a good way to go it. No financial advisor is going to tell you about this because they don't get any commissions. Why would they? A fiduciary is a financial planner that passes a bunch of more tests, and they are legally obligated to work on their client's behalf. In other words, they don't make money on your money. A fiduciary usually charges a flat rate. And then they give you, this is what I'm going to charge you. This is what I'm going to do for you. And you may make more or less through a fiduciary or not. But it's a lot harder to become a fiduciary than it is to become a certified financial planner. Okay. And you won't find CFPs, you won't find the people you call it, Charles Schwab or Vanguard or you name them, talking about these Series I savings bonds because they don't get any money. Okay. Money in the middle. All right. So for interest, you want to be able to maximize your interest. So when you buy a stock, what are you looking for? Okay. Let's have some fun by looking up some stock forecasting. And I'm going to go to the finance. Let's use, who's pretty good these days? Yahoo's is pretty good. And I'm going to look up, let's see, Occidental. This is a petroleum company. Okay. So you want to drill down, figure out, okay, how do I know if I want to buy this stock? Now remember, stocks are volatile. Buyer beware. You're more likely to lose money than make money in stocks. Okay. So I'm going to go 5 years so we can see it. Okay. But, and as you can see the graphs, and this is where AI is going. All right. Who's talking? Let me see if I can.
I don't want to talk about. I don't want to talk about boys. I don't want to talk about boys. I don't want to talk. I want to talk about the girls.
There we go. That's the person who is talking in the background. Got it. All right. So you can see what Occidental is doing over 5 years. Okay. Stays pretty stable. Okay. But as you read through this, what am I looking for? How do I know I'm going to make money? You don't. But what you kind of want to look for as a beginning investor is something called a dividend. So as the stock makes money, they pay you to keep the stock. And that dividend goes back into your trading account. You can build a portfolio completely on dividend stocks. Now, will that make you more money in the long run? Maybe, maybe not. Who knows? The problem with dividends, if the company says, hey, we're not going to pay it this year, you have zero control over that. Okay. And the other thing is, hey, I want to invest in the companies that I use. Okay. All right. I use Google all the time. Let's invest in Google. All right. Let's look at that. All right. 127. Look what's happening here. Boom. Why do you suppose it's going up? AI. A lot of the big tech companies are going up because of AI. Okay. Now, here's an interesting one that I personally have. I like it. And this is Berkshire Hathaway B. This is one that, see, I'm into it way back. Well, I got mine, one of those about, down here, because I knew it'd go up. I don't have very much in it. Wish I had more, but you can only spend so much on this. You have to kind of make it as a hobby. If you go to Nevada and gamble, consider this money as gambling money that you might make money on, but also plan on you might lose it. Okay. There's no guarantees when it comes to stocks, but when you go into bonds, you have a much safer approach to it, because when you buy a bond for $10,000, you know you'll get that $10,000 back. Okay. You may not make great returns, but you know you're going to get that 10,000. So it's super conservative. Okay. And that's what these two books talk about. And using bonds, how do you create a portfolio out of bonds using the yield curve and the different ways in the, so, hey, I want to buy this bond that is 5 years in, and I can get it for 60 cents on the dollar. And if I hold it for 2 years, I can sell it for 75 cents on the dollar. Buying and selling bonds takes some time to learn. This book here is the cleanest I've seen. Very good. Very good. So here we have this particular book, and the old version is the one I have, and I still refer to this because there are explanations of how the bond yield curves work. I go, oh, that makes a lot of sense. And then I'll look at their formulas, then I'll look at some of the bonds that I've got and going, yeah, I need to sell these puppies. And then I'll go buy something different. So it's very helpful. And what is it? $9, $4. But this new one, I think, is an electronic format, so you can use it to save it. Okay. So bonds versus stocks. And the reason I like Berkshire Hathaway is that you've all heard of Warren Buffett. This is his company. Actually, when you buy a share of Berkshire Hathaway, it's more like a mutual fund. He invests in very solid companies with very solid management and lets them do their thing. So, for example, there was an Israeli company that needed to scale out some of their precision stuff. They didn't have the capital or access to capital. So they talked to Mr. Warren Buffett, and he understood what their business is, very niche, very military, very high precision. So he invested in this company, and I don't know how much he gave him, but then now the company can expand. As it expands, he gets the money back. Okay. So when you have a single share of Berkshire Hathaway B, you're actually getting a little piece of those 70 companies. All right, now let's look at something different. Berkshire Hathaway A. You got enough money to buy one share? That's one share. It's $500,000 and it went up $9,000 today. So where do you think the big boys are putting their money? It's called eating the emperor's grain. Find out what the super rich are doing and then kind of try to follow along using not quite so much money. And the question I got, don't they charge commissions? Well, you can't go to Berkshire Hathaway and say, hey, I want to buy one share of your stock. You can't do that. You have to go through a stock broker. And that could be Vanguard or Fidelity or how many? Schwab, T. Rowe Price. But to open a stock trading account, they call it OTC, over the counter. You can do it at your local bank, but they're going to charge you a lot more for commissions for each stock. What they do is they usually charge a fee. I've seen it as high as $20 to buy one stock. And then Vanguard is a little lower, like $9 a trade. But with Vanguard, it takes, $5,000 to open an over-the-counter. So there's E-Trade. At one time, they were really inexpensive and not so much anymore. There's other companies in this play that do that, okay, that you can buy and sell stocks. But you need an account to buy and sell stocks through. It's like writing a check. You can't just get a check from the bank and then just write a check. You have to open an account, get a number assigned to you, put money in it, then you can write your check. That's the same way with an OTC, over-the-counter stock brokerage account, okay? So that's how that works, okay? It really depends. And the Robinhood, the problem with a lot of these companies is they take a bunch of hey, let's get a family gathering together. And we got 300 people in our family and we're all going to pitch in $50 and we want to buy a stock through Robinhood. And they buy the stock through Robinhood and it goes in their account. And then you go to cash it. Robinhood is not insured. There is no obligation for them to give you your money back. So you want to make sure the brokerage firm is truly legit with a track record. These new ones, fine, try them, but don't put a lot of money in them because they'll go bankrupt or disappear. Like what happens to some of the insurance companies? State Farm will not insure property in California. Do you blame them? So it is possible to go, and insurance companies can go bankrupt. Then you're left holding the bag. Okay. All right. Now there's so much in this that you should start learning about it. Take a class. There's online stuff everywhere on learning how to do this, how to build your portfolio. One of my favorite go-to sites for learning stuff are these guys. They are delightfully irreverent and they are just fun. Let's see, the two brothers that started basically took information and they kind of opened their own little stock advising firm. And they are certified and they've passed their Series 9 and all that stuff and the Series 7. So they're legitimate as far as knowing the market. The older brother said, okay, I've got $1 gazillion. I'm going to open a nonprofit and I'm going to go save the world. The younger brother is still in the game, still helping people make money. And their advice is pretty spot on. and delightfully irreverent. They also have bond funds, or they have funds that you can invest in, but because their funds started making so much dang money, they had to break it into a separate entity. So if you want to buy a mutual fund, and all you have to do, you can go straight to them. I think it's Pool Funds, I think it's called. Funds Asset, yes, this company, Asset Management, where you can actually open an account with them and they take care of you. You just put a bunch of money in it and they take care of it. Okay. But they're going to charge you a little bit of a commission. Now, if you are a fifth generation super rich 15, and you're going to college with a trust fund of $50 million, the commission isn't going to bother you any. But when you're first starting out, you want to be very cognizant of how much stuff costs. The buzzword for ETF, electronic trading, is load. How much load does the mutual fund have when you buy it? So if you have a bond or a fund that's 4%, that means of all the earnings, they take a 4% right off the top to pay their people or the stockbroker or, okay? Now, this is just an FYI. I am not recommending these folks. That's just whatever you see fit. Where do you find legitimate information? For years, I belonged to some bulletin boards and stock tip places, and some of these people would give good advice, very solid advice, and then they would start sending out spam emails, getting people to buy these penny stocks. So they, as day traders, could invest in penny stocks, get people to buy the penny stocks, it would go up, and then they'd sell their half, and then everybody else was left holding the bag. So you want to be, when somebody says, oh, this is too good to be true, it probably is. If it sounds really, really good, double check. Find another source or another source or another source and verify. Because caveat emptor, buyer beware. It doesn't help you, it helps the other people. Okay. Yeah, Robinhood got sued, so they had to change their game. Okay. Oh, the Alley Bank. That is a very interesting play. I've been watching them. The Alley Bank is a very legitimate old school bank online. Now, I don't know how much of a track record they have, but here's something I can tell you. I have a friend who is a commercial lending agent for banks up and down the Central Valley for 40 years. And I'd ask him about credit unions, and he would literally turn red and fume. Credit unions are held to a very different standard. They are still insured, and you generally will make a little more money in the checking account and a teeny tiny bit more money in savings, but it's not a lot. But they don't nickel and dime you to death for overage, or you run out of checks, or, they don't nickel and dime you to death. But you also have to realize that your credit union is regional. It's going to be geographically bound. So if you know you're going to be traveling in the country, getting a bank account with a nationwide bank is smart, okay? Because then it's a lot easier to get access your funds from Chase than it is from, say, Golden One Credit Union when you're in Florida. You can ask me how I know that. They've made it a lot easier. But you do have to spend some time finding a credit union that has an agreement with another credit union so you can move the funds so you can get access to the cash. Sometimes you're stuck and you can't get your money because you're in the wrong place. And then same thing goes for traveling overseas. Okay. All right. So that's kind of a broad brush of what we've done. So bonds, here's a recommendation of a book that I consider good. Treasury Direct, you can buy bonds on your own, no commission, no fees, you just get it. Show you my portfolio? No. That would break so many ethical rules. Sorry. Ha. And then for stocks, look at them before you buy them. And the reason I like to I'll watch it for this. If I'm going to immediately buy a stock, I'll go look at some of this information. And when I say learn to read financials, folks, this is what you want to learn how to read. These things. Is the company making money or not? This is how I saved my bacon, literally. I was working for a company, and I will not name them for the sake of what they did was pre-Sarbanes-Oxley, and what they did I would consider very unethical. They basically did a pump and dump on the stock, and then the family that owned it sold it, and then the division I worked for, everybody lost their job. But if you knew the financials, you could see that pattern. This is also another way to find out if you want to actually work for a company. What are their financial statements? Okay. What are they? Are they in the red or are they in the black? Because if you get hired for a company that's in the red, maybe there's a legitimate reason. They just bought their biggest competitor. Well, that would explain why they're in the red for a little while. They're trying to get the two company cultures to go together. So learn how to read financials. You don't have to, it's not that hard to find what those are, okay? All right, so, and then stock advice, yeah, you get what you get paid for. Rule of 72, learn how to calculate compound interest. And when you go out and get a credit card, you've probably all learned this lesson the hard way. They make credit cards so easy to get. Is so easy to get one of these things, but they'll get you in trouble so fast. I like to go to the other types of places that are not affiliated with a bank. So look how much you have to pay them. You have to pay 20% interest. If you just think about that just for a second. 20% on a credit card. So that $200 weekend, you're going to end up paying an awful lot of money back. Yeah, if you use a card, don't pay, just pay it off every month, because that's where they kill you. And what they will do is that they will change the dates that your credit card closes. It's a lot like they usually set it something weird, like 26 days or 28 days. So you'll get in the habit of paying it at the same time every month, and then you're going to miss a payment. And then all of a sudden you've got this $50 interest rate charge because the balance rolled over. So this is one of the fastest ways to get yourself in trouble with credit is with a credit card. So if you pay it off every month, that's what I do, comes in really handy. If I can't afford to pay it with cash, I'm not going to buy it on a credit card because I don't want to pay interest. It's crazy. And then I've had students tell me, oh, I just go get another 0% interest card. But you know what's going to happen? Okay, I've got $5,000. I'm going to go put it on a credit card and put another $5,000 on another. So by the time you're ready to pay everything off, you got $25,000 in credit card debt, and your credit rating is trashed. And now you're stuck. So I think the simplest investment advice is live below your means, and you'll always have enough. So save more than you spend. Pretty basic rule. And there's no quick fix to getting rich. Okay. It's not timing the market that makes you rich. It's time in the market. Okay. So it's great to have a credit card, makes travel easy, but make sure you have a savings account to pay it off, because it's easy to get stuck in the spiral down and then you're stuck. It's hard to get out of credit card debt. It really is. It's tough. And stocks are a good way to go if you're not afraid of risk. Bonds, they're a lot more conservative. You don't lose money in bonds per se. Okay. Yeah. Okay. So I think I beat a dead horse on this money stuff. So the reason I wanted to bring that out is Treasury Direct and the Series I bonds, because they're making good interest. And then the new issue of bonds that are at 6.919, they're only opening in that for, I think, 3 weeks, and then they're going to close it. So if you want to get in on that, you'll have to open an account, and I think they transfer money out of your checking account. They will not let you use a credit card to buy a savings bond. They're not going to do that. Okay. And most brokerage firms won't let you do that either. But if you want to get more into this stuff where you're doing margin, where you're using other people's money to make money on, basically it's like a short-term credit card at ridiculous interest. And if the margin goes against you, you can lose over 100% of your investment. But if margin goes for you, you can make 200% on your investment. That's very high risk, very high yield. Margin trading is, I don't recommend it to anybody who's an amateur. It's somebody who's got a lot of money and they can lose it. Like, the way to make $1 million in soybeans is to start with 10 million, because you're going to lose 9 of it. Okay. All right. Now let's move on to this next little topic I want to talk about. And I want to go here, 290. I want to talk about these two things. But before I do that, I'm going to mention the book I just finished reading. It's Michelle Obama's book on the light we carry. And it was a very interesting read. Let me start with a story at Foster Farms. When I was working down there, emotion was never allowed as far as expression. Okay. Okay. Hey, Charlie, kind of tone it down a little bit. Maybe I should do my last topic next. But at Foster's, I saw this happen more than once. If you were a male manager and you lost your temper, you could look at a calendar, and with 8 months, they were set free to pursue other opportunities. So getting mad in the workplace was tacitly, no. And for women, it was don't cry, or same thing. Well, I totally understand why a woman would cry at Foster's. It was a terrible place as far as the environment I worked in. It's probably not that way now because I've been gone for so long. And I'm sure they've had lots of trainings, and a lot of the old people, old guard, are gone, and they have new people there. Okay. But the reason I want to bring up this All the Light We Can See book is that she mentions some very interesting things about dealing with or working in a workplace that is predominantly old white guys. She used a term called code switching. In other words, you change your work persona from your home persona. Now, all of us do that to some extent, okay? All of us have a work face and a home face, okay? We turn on things, we set up our guard a little more, we're not 100% transparent at the workplace. It's something you do naturally, okay? Now, I can tell you when I was at Foster's, there was never any empathy, okay? There was not any sympathy either. This is a true story. When my first daughter was born, it wasn't Foster's. I wasn't given any time off. They told me, yeah, you get a day and a half, but you need to come back to work. That was really sad. And the laws have changed. So companies have to give you paternity. And it's your right to take your paternity and your maternity leave, use it. So you can't really legislate it, but the empathetic workforce, they're realizing that you can't treat people rudely and expect them to stick around. And so companies are realizing, hey, I need to teach people how to be empathetic so I can make more money. But yet on a human level, empathy just makes you a better person, okay? And that's it's kind of what, the universe gives you the gift of life, and what you do with it and how you end it is your gift back to the universe. It's totally up to you what you want to do with it. But I think being kind is better than being rude, All right. So in this empathy arena, it doesn't cost you anything to be kind and to smile. This one down here, Smile Power, is part of it. And this is
because my t-shirt sucks.
A wonderful little superpower. And he talks about how smiling actually increases your lifespan, and how smiling increases endorphins. And it's a really interesting study. And he quotes the research, even though it's a little dated as far as the research. You just go to PubMed and search on smile and look for the articles in PubMed. It's all open research stuff. This Simon Sinek, he is a business consultant of first class magnitude. And this is actually a really fun talk. And he is going to ask very pointed questions and saying, I should not have to be here talking about this topic. But why is he? There's a lot of reasons why there's so much angst in the workplace. Work from home arguments, return to office arguments, uncaring bosses, so on and so forth. And then the crux of this is, what is the difference between sympathy and empathy? Okay. So the last part of this assignment is I'm going to assign you those 3 videos, and these are your guest speakers. Okay. And what I want you to do is you're going to give me the definition as you understand it between empathy and sympathy. And then you are going to highlight what the video that Simon Sinek talked about, what did you get out of it that you thought was neat? I'm not asking you to summarize it. I'm asking you to find something that you can use on your journey of life. Okay. Same thing with the smile power. What is it? Will it help you or will it hinder you? Okay. You know, that type of thing. The body language one you can look at just for fun. That one is different. And I'll get the assignment posted this evening, so I'll have some place to put this stuff. So it's really simple. Basically, you're going to watch the 3 videos and you'll take notes and you'll submit a PDF as the assignment. Okay, that's all there is to it for tonight. So the Zoom meeting evenings, for the most part, will be somewhat truncated for a multiplicity of factors. When I do get a guest speaker lined up for Zoom, it will depend totally on what they are available for. So if they are only available from 4 to 6:30, well, I'm going to record them and then we'll play that for the class. Right. So that's kind of how that'll work out. So that's kind of where we are with the trainings. Now, I can leave the Zoom open and you can break off into your teams, but I personally find using Slack much easier to use to communicate with your teams than using Zoom chat, because it gets noisy. All right, now the very last thing I want to do is maybe I'll hold off on that. It's a much better topic for in the classroom. I think I'll just hold off on that last one then. All right. So the speaker tonight is videos, and there's 3 of them, and none of them are very long. They're mostly TED Talks, so they're short. The sympathy empathy one is, I think, 6 minutes, and the other 2 are TED Talks, so they're really short. Okay. And on that note, did I hit record? I can't remember if I did. Yes, I did. Okay. So I'm going to, is there any questions on the topics tonight? Any more? Because I can go back and revisit more of the information about stocks if you have, or bonds or whatever, if you have specific questions. I'm not a financial analyst, but I do have 2 MBAs, one in computer science and one in leadership. And I did a lot of financial programming in industry. So, bonds. If you are a California citizen or a resident, the California muni bonds, which you can get by way of an OTC, are non-taxable. So all the money you earn, you don't have to pay state tax on. Okay. The US Treasury is the easy way to get started. It's called Treasury Direct. And it's very simple. Well, opening account is not very simple. They basically ask for your DNA. And then you can buy these at any increment, at any time. They send you a big old long serial number. And then here's the nice thing about it. You can take that serial number with your ID to any bank or credit union and cash it. Okay. So you don't have to cash it through the Treasury Direct. Think of it as buying basically you're giving the government your money and they are going to give you interest for using it. And then they're going to give you all your money back. And the I bond, this is, you are not going to find 4 or 3% in a checking account anywhere, unless you have like $100,000 in the checking account, and then they'll give it to you. But this is really a good saving, and it protects you against inflation. Okay. And you can just buy these straight across the top. Okay. And they tell you all about it. And it's called TIPS, Treasury Marketable Inflation Protected Security. Okay. So they compare the EE, which is the standard savings bonds. We used to call them war bonds because this is how the government got money to fund World War II. Rich people and poor people bought war bonds, basically saying, here's our money, use it for the war effort. When the war effort's over, we get our money back plus interest. Yeah, Argentinian bonds are like 100%. I would be careful with those because they may or may not be callable. And then how do you redeem the money if you're not a native? Like in France, you can go buy property. But if you're not a French citizen, you can't sell it. So, caveat emptor. Okay. So, but this is really, if knowing what I know now, if I was your age back then, this is what I'd do. Okay. Because in those days, in the early days, $30 would buy you a week's worth of groceries. So nowadays, it's not quite that. Okay. So this is great. And if you don't have to buy anything, you can open the account, learn. There's it's got tons of information on it. And that it gives you tax information, what you have to do, what the historical record is, and so on and so forth. The electronic ones, paper bonds, they'll send you a paper one. You have to buy a bigger chunk. I don't know what the number is. I thought it was 1,000, but might be more than that. But these are all 30-year bonds. Okay, so you hold them. You don't have to hold them for 30 years. You can redeem them for whatever you want after 12 months. Okay. So if you buy it and say, oh no, I need that money, you got to wait 12 months. So make sure it's something you can live without for 12 months. Okay. So it shows you how it's calculated. They got these calculators. Somebody had to figure that out. Bet you that was fun. Okay. And how it affects state taxes. Okay. There you go. Electronic. You can buy it in $25 increments. Okay. Above that, you can say, hey, I want an I bond for $36.73. That's crazy. Paper ones are $50, $100, and so on. So you can buy one $50 bond and have it sent to you in a paper format that you can put in a safe deposit box, okay? And then they give you a limit, okay? So you can't go crazy buying these as an individual. Institutions, there's a whole different way to buy bonds. They have a whole different channel, okay? Other questions? Your silence is consent. Okay. Okay. All right. Now, on that note, I will stop the recording. Stop recording.